The last time I saw a disconnect between the headlines and the actual plumbing of the financial system, it was 2008. Everyone was watching subprime mortgages on television, but the real contagion was happening in the overnight repo markets where cash simply stopped moving between institutions. Today, we are living through the exact same dynamic. The headlines are louder, the denial is deeper, and the magnitude of the distortion is orders of magnitude larger than anything in human history. I am not speaking to you today about a stock market correction. I am not speaking to you about a recession. I am speaking to you about a fundamental breakage in the way money functions across the entire globe. And if you own gold or silver right now, you are holding the only two assets that exist outside of that broken machine. You are likely looking at your portfolio with frustration. You bought precious metals because you see the debt clock ticking toward infinity. You see governments printing trillions of dollars out of thin air. You see geopolitical tension severing long-standing alliances. And yet your screen tells you that you are wrong. Silver is hovering near its lows. Gold is struggling to gain traction against a rigged index. You feel isolated. You feel early. And worst of all, you feel the creeping doubt that perhaps the system can kick the can down the road forever. That feeling is precisely why you need to hear this message. The pain you feel at the bottom is designed to be intolerable. It is engineered to shake out the intelligent but impatient investor so that the truly patient can accumulate at prices the fundamentals suggest should be impossible. I am going to give you the hard data points today. I am going to show you the specific unfolding mechanical failures that the evening news is ignoring. And I am going to explain why the apocalyptic scenario that so many fear is not coming. It is here, right now, hiding in plain sight inside balance sheets that have not been audited in truth since the last crisis. By the end of this video, you will understand how the Federal Reserve's own emergency lending facility has become a permanent stealth bailout that is silently draining liquidity from the system. You will understand why the silver lease rate, a metric almost zero retail investors track, is flashing a warning that precedes violent repricing events. And most importantly, you will understand the bail in reality, which is the actual legal mechanism for how your bank account could be confiscated to save the bank itself. Once you understand these three realities, the decision to hold precious metals changes from speculation to self-preservation. Let me start with the most misunderstood number in the world economy right now, the U.S. debt service cost relative to tax revenue. It is not just the $39 trillion total liability. It is the cash flow problem. The United States government paid roughly $879 billion in net interest payments to service that debt last year. That sounds large, but that is actually the old number based on lower rates. We are refinancing roughly $9 trillion of that debt over the next 18 months into a yield environment that is structurally higher. If the average cost of servicing that debt rises to 4.5 or 5%, the annual interest payment alone will exceed $1.6 trillion. Now compare that number to the actual taxes collected. The U.S. federal government collects approximately $4.9 trillion in individual income taxes annually. Do the math. The government is rapidly approaching a scenario where the interest payment on the past consumes nearly 1/3 of all individual income tax receipts collected. Write that down. 1/3 of your income tax goes solely to pay interest to foreign nations and wealthy bondholders who lent us money to buy tanks and welfare checks. It produces nothing. It builds nothing. It is pure wealth transfer. This is not an economic model. This is a death spiral. When the market realizes that the United States can never tax enough to cover this hole, the dollar's purchasing power must adjust violently downward to compensate. The apocalypse is the realization that the denominator, the currency, must shrink to fix the numerator, the debt. But let me move to something even more critical, something happening right now beneath the surface of your trading screen. People keep asking me when the banks will crash. They do not understand that the banks have already crashed. They were bailed out in silence using a tool called the Bank Term Funding Program, or BTFP. When Silicon Valley Bank collapsed last year, The Federal Reserve created this emergency lending window. It allowed banks to borrow cash against their underwater bonds at face value. Essentially, the Fed pretended bad loans were good loans to prevent a run. This program was supposed to be temporary. It expires soon. More importantly, it effectively merged the banking sector with the Federal Reserve's balance sheet. Banks are now using the Fed as a backstop to survive. But here is the terrifying reality. While bank borrowing costs are artificially suppressed by this program, interest rates paid to savers and depositors are rising. This creates a margin compression that strangles the profitability of regional banks. Regional banks hold a massive amount of commercial real estate debt, specifically office buildings. Those buildings are currently emptying out at historic speeds due to remote work. If those loans default, and they are defaulting, the FDIC insurance fund, which is tiny relative to the exposure, would be wiped out. This triggers the legal provision I warned you about earlier. The bail-in, under laws passed after the 2008 crisis, including the Dodd-Frank Act in the United States and similar resolutions in the EU and Canada, the government does not have to bail out the depositors. They can legally convert your unsecured deposits above a small threshold, typically $250,000, into equity shares of the failing bank to recapitalize it. You get a stock certificate where your checking account used to be. This is not a theory. This is written law. The collapse is not the stock market dropping. It is the realization that your currency in the bank is legally defined as an unsecured loan to the bank. In an apocalypse scenario, that definition matters. This brings us to the first specific reason why I believe the upcoming wealth transfer into precious metals will be unlike anything in history. It is no longer just about inflation hedging, it is about counterparty elimination. Most financial assets rely on someone else's promise. Your savings account depends on the bank. Your stock depends on the corporation. Your treasury bond depends on the government's willingness to pay you in future diluted dollars. Physical gold and physical silver do not depend on anyone's promise. They are the only assets where the asset and the settlement layer are identical. You hold the payment, you do not hold a claim. As we enter a phase of increasing credit defaults and potential bank nationalizations, the only safety left is the thing that settles instantly and requires no counterparty signature. Now I want to zoom in specifically on silver because the data emerging from the metals exchange is screaming something that the price chart is refusing to admit. For years, analysts have talked about the industrial demand for silver, solar panels, electric vehicles, semiconductors. That narrative is correct, but it is incomplete. There is a second, more powerful engine starting now, the energy transition grid upgrade. A single advanced solar installation can require more than double the silver of a traditional one. AI data centers are being built at a pace of billions of dollars per month and consume massive amounts of electricity. To deliver that electricity efficiently without overheating, the grid requires high voltage cabling that relies heavily on silver for conductivity. The demand is exponential. The supply is linear. Mine production is flat. But here is the unique indicator I want you to watch. The silver lease rate. When big bullion banks want to manipulate the price of silver downward, they often lease metal to dump onto the market. To entice holders to lease out, doubt their metal, they have to offer interest. Right now, the silver lease rates are starting to behave strangely. In a healthy market, lease rates remain low. When rates spike or turn negative deeply, it means the available physical bar inventory is disappearing. The LBMA clears hundreds of millions of ounces of paper contracts, but reports suggest that the actual deliverable vaulted stock, bars actually sitting in a warehouse ready to be delivered, is a fraction of what is claimed on paper. If demand for physical delivery rises by just 15%, which is what happens when Asian sovereign funds decide to shift allocation, that thin layer of physical metal evaporates. When that happens, the paper price set by futures does not change immediately. What changes first is the premium. You see spot silver at 22, but you cannot find a single kilobar for less than 2025. That spread is the crack in the dam. Once that premium widens irreversibly, the spot price on your screen becomes fiction. The real price becomes whatever a seller demands to part with their physical property. This is what I mean by apocalyptic rating. It does not happen gradually. It snaps. I watched this phenomenon begin in physical copper a year ago, where wire manufacturers could not get delivery regardless of the COMEX quote. The same architecture exists in silver, but with a monetary overlay that copper lacks. It's not our job. You are looking at a metal that is both essential for the technological evolution of humanity and essential for the preservation of wealth during the economic destruction of that same evolution. No other asset has that dual necessity. Platinum is industrial but poor as money. Bitcoin is monetary but useless for building machines. Gold is monetary but scarce. Silver is both abundant enough for industry and rare enough for money. And we are burning it faster than we are pulling it out of the ground. The math is not a suggestion. It is a deadline. Let me challenge you with a scenario you probably have not considered. What happens if the BRICS nations, Brazil, Russia, India, China, South Africa, and the new members joining this bloc decide to issue a commodity-backed trade unit for international settlements? They are meeting specifically to create alternative payment systems that bypass stub IFT. They are accumulating gold aggressively. If they introduce a trade unit backed by oil or gold to settle grain purchases between Egypt and China, or energy purchases between India and Russia, the demand for physical gold and silver shifts from investment to infrastructure. Infrastructure demand does not care about the Fed funds rate. Infrastructure demand does not sell on margin calls. If gold and silver become the plating for the new non-Western financial rail system, the Western pricing models become irrelevant. That is the apocalyptic scenario for the dominance of the dollar index. It does not mean the dollar disappears tomorrow. It means its monopoly power breaks. When a monopoly loses exclusivity, the price of the alternative explodes geometrically. I want to talk about the psychology of the waiting room, because this is where investors are getting hurt the most. Right now, there is a war being fought on your nervous system. Every morning you wake up, check the price, see red, and experience a micro dose of trauma. That trauma accumulates. Eventually, you reach a pain tolerance limit. Usually, the limit hits right before the reversal. This is biological. It is not analytical. Professional traders who manage billions use algorithms specifically to remove this emotion because humans are programmed to cut losses before ruin. But as a physical metal holder, your loss is only realized if you press the button. Consider the fiscal year-end factor. Large institutional flows often reallocate around quarter ends and fiscal year ends. During periods of political uncertainty like an election cycle, portfolio managers tend to de-risk by dumping volatile assets like metals into thin liquidity. This creates artificial selling pressure that has nothing to do with the fundamental value of silver or gold. You are watching your portfolio drop because a pension fund in Boston is rebalancing their spreadsheet to hide risk exposure before client meetings. That is the unfair reality of the paper market. The paper market prices things based on accounting deadlines, not physical scarcity. Do not mistake an accountant's spreadsheet adjustment for the intrinsic value of the Earth's rarest monetary elements. So, what is the actionable reality? If you accept the premise that the debt structure is unsolvable without devaluation, and you accept that the banking system is reliant on a stealth bailout that may be ending, the strategy is not complex. It requires only one thing: possession. You must decouple your wealth from the banking ledger. If you hold gold or silver, ETFs or pools, understand that you own a claim on a custodian who claims to hold bars in a vault you cannot audit. In an apocalyptic credit event, the custodian fails before the asset manager. The manager fails before the broker. The broker fails before you only by taking physical possession of coins or bars, or by using a fully allocated, segregated storage provider with explicit bailment agreements and insurance. Do you remove yourself from the pyramid of derivatives that will crumble? It is boring advice. It involves driving to a safe deposit box or arranging secure logistics. It feels inefficient compared to clicking buy on an app. But efficiency is the enemy of safety in a collapse. The efficient portfolio assumes the counterparty pays off. The safe portfolio assumes the counterparty fails. I want to finish with a very specific warning about timing. Many people ask me when to sell. My answer is not what they expect. You sell when you see one specific headline. Government announces forced conversion of private retirement accounts to government bonds. Governments facing sovereign debt crises eventually target the largest pool of captive capital they control, the IRA or 401k system. Argentina did this. Hungary proposed it. It is the nuclear option. Before we get anywhere near that stage, gold and silver will have moved far beyond prices that allow entry for average wage earners. If you wait until the panic is visible on mainstream news to prove the thesis, you will be priced out of the lifeboat. You do not wait for the iceberg to hit the ship before you decide to put on your jacket. You put it on when you hear the scraping noise against the hull. We are hearing that scraping noise right now. There are two distinct groups of people who will analyze everything I have said tonight. Group A sees the macro numbers, understands the debt, knows the history, but then looks at the FOMC dot plot. It's not our job, listens to the Federal Reserve Chair say higher for longer and decides to wait. They wait because they still trust the machinery of the central bank to maintain order. They wait because they fear the opportunity cost of holding non-yielding assets in a high-yield environment. They sell when the drawdown becomes unbearable. They provide liquidity to Group B at the absolute bottom. Group B understands that higher for longer is simply a polite way of saying the government cannot afford to lower rates without crashing the currency, so they will break the fiscal budget first. Group B looks at the dollar index at 104, sees strength, and realizes that a strong dollar crushing commodities is the last desperate gasp of the old monetary regime. Group B accumulates physical metal during the suppression caused by that artificial dollar strength. Group B ignores the daily candlestick because they are reading the quarterly reports of refineries and mints. Group B is preparing for a world where the contract is honored, not just the derivative bet. The collapse is accelerating. The BTFP program is masking the rot. The commercial real estate sector is a ticking bomb inside the regional banking system. The sovereign debt curve is inverted globally. And at the intersection of this chaos sits the smallest, most manipulated, and most physically vital market in the world, silver. If you have made it this far, stop relying on my voice or any other voice. Run your own investigation. Look at the LBMA clearing statistics if you can find them. Read the FDFE rulebook regarding orderly liquidation authority. Check the monthly import and export data for silver flowing into India and China. Build your own conviction stack. But do it quickly, because when the quiet ice age of liquidity thaws and the flood comes, the distribution channels for physical metal will slam shut, not because the metal is not there, but because the owners of the metal will finally realize they are holding the only true liquid asset on planet Earth. And they will not trade it for a number on a screen anymore. That is the moment we are approaching. That is the terror behind the warning. Prepare your position. Protect your family. Hold the metal. The screen lies. The shelf does not. If this kind of deep structural analysis helps you navigate the next 12 months without losing your position to the manipulators and the algorithms, then make sure you are here for the next update, because the next phase of this transfer, the physical squeeze, is not going to be announced on Bloomberg. It will happen on a Tuesday afternoon when the premiums blow out, and only the people holding the bars will know what just happened. I will see you then.